Hello there. Well, we often say that the four most dangerous words in investing are "this time it's different." Occasionally you get these periods where markets and fundamentals seem to sort of get dissociated from each other and the usual rules seem to not apply. So a good example is in the late 90s when we had the so-called technology bubble. Any company with a kind of .com in its title, the share price went ballistic, even if that company wasn't making any profit or any revenue whatsoever. And of course, what tends to happen when you get those periods is eventually the usual rules do start to apply again, and that can often have dramatic consequences, as we saw when the tech bubble burst. But what if this time the rules maybe have changed? Since Donald Trump has become president of the US, we've seen what appears to be a real kind of change in the whole world order of things, if you like. So, for example, as he did in the last time he became president, he's imposed lots of trade tariffs, which are essentially taxes on imports. But this time, rather than just targeting the likes of China, he's also putting quite large tariffs on some of his allies, such as Mexico, Canada, and probably Europe, and even that might well include the UK. He's also doing some other things. For example, some of the ways that he's acting with regards to Russia and Ukraine has really made European countries in particular think very differently about defence. They perhaps feel that they can no longer rely on the US to help them with defence anymore. And certainly what we're seeing is those European countries and the UK to an extent look like they're going to start spending a lot more on defence. Even the kind of famously frugal Germans are making some changes to their so-called fiscal rules that allows them to spend more. At the moment they have this thing called a debt brake that essentially allows or makes the German government not able to borrow more than a certain amount. And what they're doing is excluding defence spending and infrastructure spending from that debt brake. So essentially it means the government is allowed to spend more and borrow more than they have done in the past. If we turn back to what's happening in the US, we've got the so-called Department of Government Efficiency, or DOGE, led by Elon Musk, which is essentially going through the US government payrolls, the number of employees and all the different departments, and looks like we're going to end up with some very, very big layoffs, lots of people losing their jobs, lots of consultants no longer being hired. So lots of things going on that could really have a significant effect. And we don't know how much of this is rhetoric, how much of this is going to be permanent, or how much is going to be a short-term move. But if we just sort of analyse what could happen, well, trade tariffs are usually seen as inflationary because essentially it pushes the prices up, and are likely to reduce economic growth because it can kind of reduce the consumption. People make it maybe less likely to buy goods that are now more expensive. So we could see the US economy slow a bit and inflation there go up. In Europe though, because of that extra government spending, we actually could see the economy would basically start to accelerate. There's lots of government stimulus there. So we could see a bit of a disconnect. Normally, what would that mean for sort of interest rates? Well, normally, if you've got a slowing economy in the US, the Federal Reserve would want to cut interest rates. But if inflation stays high, it's difficult to see whether they'd be able to do that. But they might want to cut rates. In Europe, if the economy is starting to accelerate, then the central bank there is more likely to keep rates higher. So we could see something completely different to what we've seen over the past few years, where we've had a fantastic US economy and a very sluggish European economy. So what does that mean for our portfolios? Well, obviously it might mean that European stocks do better than US stocks. That would be a turnaround. But that is what has happened so far in 2025. Stocks outside of the US have done much better than US stocks for the first time in a while. It might also mean a weaker dollar. So we got used to quite a strong dollar, but at the moment, both the pound and the euro are now a lot stronger against the dollar than they were at the beginning of the year. And it could just mean a change in the way some of the investments behave, because normally if you get an economic downturn and stock markets fall, what tends to happen is bond markets do really well because everybody wants to pile into the so-called safety of government bonds, and because interest rates are usually cut in that scenario, those bonds look more attractive. But Perhaps if the central banks aren't able to cut rates, perhaps that might not work in the same way. So there's lots of things going on at the moment that just might change those investing rules that we've become used to. So what can we do about it? Well, as we've talked about in previous editions of the Pulse, we have been underweight US stocks for a while, so we're holding a bit less than everybody else, simply because they've done fantastically well and they've become a big part of global markets. We've done things like, instead of holding the S&P 500, for example, we've held what's called an equal weight index, which just has a bit less in some of those big tech stocks and a bit more in some of the smaller US stocks. And we've also invested in the US indirectly rather than directly by buying defined returns. And defined returns essentially are a slightly lower risk form of equity investing, if you like, because there's a little bit of capital protection built in, and because we essentially don't need to see markets go up very strongly in order to get a good return. So we've done various different things, and then the final thing we've done is we've bought what we would call portfolio insurance. Essentially what it is, it's like an insurance policy. You pay out a premium, but in this case the insurance is against the potential for the US market to fall. So if the US market does fall quite strongly, and at one point last week it did get to sort of 10% down, but if it fell any further, that portfolio insurance product would go up in price, and that would offset some of those losses. Of course, the opposite, like any insurance policy, if the worst doesn't happen and it doesn't pay out, you're going to lose the premiums that we paid, but that's okay. We'd rather that happened, because it gives us that kind of assurance that even if the worst does happen, if stock markets do fall sharply, then we've got something in there that will cushion the blow somewhat. And if it doesn't happen, great, at least it gave us that ability to keep more money invested in the stock market than we might have done otherwise, given the amount of risk that we're taking. So lots going on at the moment. Obviously, by the time you actually see this, it'll probably have changed again. Trump may well have rolled back on some of the tariffs or introduced some new ones. It'll keep being like that, I think, for a while. We might see a little bit more volatility in markets, but there's lots we can do to kind of protect portfolios, and then hopefully if markets do take a further downturn, we can, as usual, try and take advantage of those lows and buy in at some dips. So I hope you found that useful, and we'll see you again next time. Thanks.